world is speeding up, and Sri Lanka is progressing with it. Succeeding in this time requires innovative strategies and a performance-driven mindset. For over 35 years, First Capital has put performance first in everything we do. We have optimized every aspect of our operation to deliver the highest performance and results to our stakeholders. As we march into the future, we are committing to elevating our services even further, moving forward with what we believe in to provide you with a premium service, delivering on our promises, finding the best solutions for our clients, going above and beyond to deliver value, and upholding the highest levels of professionalism. Rest assured, every step of the way, we will deliver performance first in everything we do. First Capital, performance first, always.
Very good evening, ladies and gentlemen. We warmly welcome all of you to our 5th Economic Forum. Today's forum will take you through our media outlook for year 2021 and the Renewable Energy Sector Forum. Let me start with a quote by Warren Buffett. "Be aware the investment activity that produces applause. The great moves are usually greeted by yawns." We believe that our forum today will surely enlighten you on the investments you make. This webinar is lined up in two folds. During the first half, we take you through the presentation on our media outlook for 2021 and a presentation on the renewable energy sector. The panel discussion will commence thereafter. I would also like to remind our audience to post your questions on the Q&A section of the Zoom app. And if you have joined via Facebook, please post them in the comment section below. Without taking much time, let's begin our webinar with the presentation on the media outlook for 2021, which will be conducted by Dimanta Matthew and Hiruni Pereira. Dimanta, over to you.
Thank you, Saima. I will share my screen now. Good evening, ladies and gentlemen. We are holding this webinar in a time of great uncertainty. On the local front, we are seeing multiple layers of uncertainty on the economic outlook and the external outlook as well. However, even if you look at the global front, we are seeing a lot of uncertainty that is out there. So yes, on one hand, you're seeing some sort of a recovery on the COVID-19, but then you're seeing the tapering effect likely to come in US. Then there is also possibly the Evergrande crisis that may trigger at any moment of time, leading to a global financial crisis. So wherever you look, you see a great deal of uncertainty, and we have to deal with this uncertainty. So let me start off with a quote from Peter Bernstein. "The greatest tragedies occur when people forget about uncertainty." So the important factor, ladies and gentlemen, is to know that there is uncertainty and act upon it. With that, I will go straight into my presentation. The theme for the evening for our media outlook for 2021 is fiscal weakness threatens bumpy recovery, hints IMF. So if you remember, ladies and gentlemen, 1 year ago, when we presented, we came up with the theme, a W-shaped recovery. And then in January, we showed you that we are in the second leg of this W, and that though the recovery path is on, we were more or less likely to be on a bumpy road. Now, if you really analyze the situation, there are a number of shocks that are there in the system. However, the most important of them all is the fiscal weakness, which is threatening our recovery path. And then there is some sort of potential that we may move into some sort of IMF support. We may seek some sort of IMF support. So that is, of course, questionable. So let's now dig deep into our presentation. So our presentation, first, I'll be taking you through our track record, how has the last 1 year recommendations performed, and then move into the factors that we consider for the mid-year outlook, and then move into the recommendations. And finally, it is also important to understand what our assumptions for these recommendations are, and what are the events that could occur to prevent such probability from occurring, which will allow you to take different investment decisions if things do not go according to plan. So let me start with the track record. So I will start with the bonds section. So we were expecting bond yields to rise from the first quarter onwards. So if you can see during the first half, we are seeing a sort of a slow rise in the bond yields, and then beyond June, you are seeing a significant spike, even a bigger spike. I've shown you now the September figures, which are not published in our reports that we published. So you can see the acceleration in yields beyond June. So here you can see that towards the second half of the year, we've significantly increased our expectations of the bands and expected them to reach the top of the bands. So we've been broadly accurate on that front for the first half of the year. And then this is during the September also. Last year, September, we had the same sort of view. We didn't change our expectations. In terms of policy rates, we were expecting policy rates to increase, and 2 rate hikes during the year we were targeting in the third quarter and the fourth quarter. So in August, we saw a sizable rate hike being given, a 50 bips hike. And so there's a possibility of another hike occurring during the fourth quarter. So there are also, we've been broadly accurate. However, in the AWPLR, basically the AWPR didn't move as much as we expected, or didn't reverse as we expected during the first half of the year. But afterwards, you can see that in September it has moved to 6.42%. But if you consider the first 7 to 8 months, we've been broadly inaccurate there. In terms of the exchange rate, of course, we were expecting a steep depreciation during the year from 186 onwards, and we've been broadly accurate during the first half of the year. However, thereon the currency has been controlled, and we have some recommendation changes also coming in. Then on the equity front, we've been mostly bullish during this year. So January we've upgraded our expectations, but in end of January, with the index hitting the 9,000 mark, we sort of recommended to reduce exposure, but only 10%, because we were expecting another run in the market. And also in June, we upgraded our index expectations as well, and we were expecting bullish returns during the second half of the year. However, we would like to say that we were mostly accurate because though we were expecting significant bullishness during the second half of the year, we didn't expect the index to cross past the 9,000 mark, and currently has moved to 9,500 as well. So we didn't expect the index to move that much. Let's straight away move into what the factors we consider for this media outlook. So political, economical, and external are what we are segregating it into. Under economical, we are looking at GDP, foreign reserves, liquidity, credit growth, and debt as the most important factors to consider now. And even in the external front, ratings, ability to raise borrowings, and the global fund flow are the main areas that we'll be concentrating on. So let's look at the political aspect at the moment. We believe that though things look politically stable, on the policy front, there seems to be a lot of volatility. So with that, we are downgrading our rating from low risk to medium low. So here, something important to understand is when the elections are going to happen. So in terms of provincial council elections, we feel that the government is very comfortable running the provincial councils via the governors, and we don't see any hurry to hold elections. So we believe that during 2022, it is really unlikely that there is likely to be any provincial council elections. However, local government is something to consider, where during February 2022, the local government is expected to expire. However, it is important to understand that the cabinet minister has power to extend the period by 1 year with some by bringing some amendments. So with that, we feel that there is likelihood with the current scenario that the elections is likely to be held in 2023. So we feel that due to that, there may not be elections in 2022. So we saw a new foreign minister coming in, and with that also we are facing a number of fiscal issues. With the issues being faced, we've brought in a new central bank governor as well. So some of the decisions that the government has taken has gone really unpopular. So to name a few, the delay in importing vaccines, the fertilizer ban, the teacher salaries, and most recently the rice prices. So all these, if you really take into account, it has somewhat forced the government into going into a cabinet reshuffle as well. However, it's really not clear whether it has solved the unpopularity that has taken place due to these issues. So we are sort of marginally downgrading our risk profile from low risk to medium low risk. So next, let's look at the economic outlook. For that, I would like to hand over to Hirni Pereira. Over to you, Hirni.
Thank you, Dimanta. Let me share the screen first. I hope my screen is visible at the moment. So I will take you through the economic outlook. So as for the economic outlook, we have downgraded it to a high risk from the moderate risk we mentioned in the previous report. And the main reason for that is the emergence of the fourth wave from August to September period. So we know even before we end the third wave, we already witnessed fourth wave. With that, even daily COVID cases in some days exceeded 5,000 levels. So with that, Sri Lanka recorded one of the highest cases in the region, even surging past our regional peers like Vietnam, Indonesia, India, and Bangladesh, although the number of daily cases now has come to sort of a manageable level. The main reason for this is the Delta variant, since it spread as twice as pace of the Alpha variant. With that, we have recorded high number of death rates, and even some days it has even climbed over 200 in September. However, on improved note, we have conducted our accelerated vaccination drive, and with that, even in some days, administered number of doses has exceeded even 500,000 levels. Yeah, so when we were doing this report, about 60% of the population has received at least one dose and over 40% were fully vaccinated. But now these, percentages are even at a more impressive level. Now it's at least 66% of the population has taken the first dose and 53% of the people are fully vaccinated. And when we compare performance with the regional peers, so these percentages have changed by now. So world percentage is 45 and Asia is 52 and Sri Lanka is 67. So what is reflected from this chart is the number of people who have taken at least one dose. So what we want to highlight here is Sri Lanka's percentage is now beyond the world's and Asia's percentage. The vaccination process, the plan of the government is to gradually reopen up the economy. So with that, the government has introduced various developments. So we now know we are about to complete the vaccination of population above 30, and we have started vaccinating population between 22 and 30. In addition to that, with regard to tourism, we have introduced various developments by the government. So one such development is a removal of on-arrival PCR test requirement at the BIA if they are fully vaccinated and if they can produce a negative PCR test taken 72 hours before onboarding. So those are some of the new developments introduced by the government with the vaccination process. So with the accelerated vaccination, we expect gradual opening up of the economy from the fourth quarter 2021 onwards, and also we expect recovery in tourism as well, although there might be some of the cases reported with regard to the Delta variant. So with that, First Capital Research has upgraded its GDP forecast. For 2021, we have upgraded our GDP forecast from 3.2% to 4%. So we know in first quarter, Sri Lanka recorded a GDP growth of 4.3%. That was well above our forecast of 2.4%. And in second quarter 2021, Sri Lanka recorded a GDP growth of 12.3%. That was broadly in line with our target. So in third quarter, what we need to remember is third quarter GDP might have some negative impact because of the emergence of fourth wave and also because of the back-to-back lockdowns we witnessed during July to September period. And also we need to remember that we are comparing our performance with the extremely strong quarter in 2020 because of the pent-up demand. So because of that, third quarter GDP might have some adverse impact. And in 2022 also, we have upgraded our GDP growth forecast from 3.8 to 4.3%. So with that, as Dimantha mentioned before, we expect some fiscal weakness to threaten our bump recovery. And with that, we expect some of the major shocks during the next 12 months. So if I name a few of them, it can be double-digit budget deficit for 2020 and 2021, and also difficulty in raising foreign currency borrowings going forward. So this shows that there will be some threats for the Sri Lanka's bump recovery, and also highlights the importance of having some assistance from IMF, although whether we actually go into IMF at this moment is sort of uncertain. And moving on to the external side of things, we expect trade deficit to widen, and with the gradual opening up of the economy and with the gradual relaxation of trade restrictions, we saw that even from the roadmap, CBSL removed the cash margin requirement on non-essential items. So with that, we expect some sort of relaxations on the currently imposed trade restrictions. So with that, we expect trade deficit to widen up to 7.7 billion by 2021 and up to 9.3 billion by 2022. However, on a positive note, we expect tourism earnings to continue from fourth quarter 2021 onwards. So this chart shows the monthly change in tourist arrivals compared to 2018 level. So we already seeing this recovery. So in August, we have recorded total tourist arrivals of 5,000. And from September 1st to September 20th, we have recorded total tourist arrivals of 15,000. So you can see in September, that number has even tripled. So we are already seeing this recovery, and is to continue from fourth quarter 2021 onwards, and to reach the peak level by 2024, and to see the similar levels what we have seen in 2018. So with that, we expect tourism earnings to record 2.1 billion by 2022 and 3.5 billion by 2023. So although there's a trade deficit, with the recovery in tourism, we expect the current account deficit to gradually reduce. So we expect a current account deficit of 2.3 billion by 2021 and to gradually reduce up to 1.5 billion with the recovery in tourism. So here we come to the government borrowing options. So when we were doing this report, we have identified some of the options available for the government with regard to foreign currency, foreign borrowing raising. So out of that, we have already received this $250 million from Bangladesh under the swap arrangement. And also we have already received $787 million from IMF under the special drawing right. So in addition to that, we also have $1.5 billion available under the standby swap arrangement from China that we can use to make for the imports from China. So in addition to that, recently from the roadmap, Governor introduced some of the other funding lines that are available for us for the next 6 months. So out of that, we have $1.5 billion from government to government loans and $1 billion from multilateral loans, another $300 million from syndicated loans. And also, interestingly, he's expecting about 1 billion foreign inflows into the government securities market. So this can be an indicator that we are expecting some upward movement in interest rates as well. And also, we are expecting $1.5 billion from swaps from other central bank. Further, it says that we have already secured another $3.6 billion from Oman as for the credit funding line for the oil procurements for the next 12 months. So those are the available funding line at the moment. So we know even during past couple of months, we had significant plans in terms of foreign raising, but a bulk of them got delayed due to the weaknesses in the macroeconomic system. So what we really need to focus here is whether we can actually materialize this within the stipulated timeline. So moving on to the other challenge, that is the foreign direct investment. So foreign direct investment has recorded $687 million in 2020, and we expect that to further reduce up to $550 million by 2021. However, in 2022, we expect a gradual improvement of the foreign direct investment with the potential sale of some of the blocks that are available in the port city. So with that, we expect continual balance of payment deficit in 2021 as well. So we expect 2.2 billion balance of payment deficit, and that to gradually reduce up to $789 million by 2022 with the recovery in tourism earnings and with the improvement in foreign direct investments. And this has created a low expectation on foreign reserves as well. So by June 2021, we had $4 billion worth of foreign reserves, and we made a 1 billion sovereign payment in July. So with that, our foreign reserves figure has gradually come down. So by December 2021, we expect $3.5 billion. And we also need to remember that in Jan 2022, we have another $500 million worth of sovereign payment. With that, we expect $3 billion foreign reserves by June 2022. So that's about 1.7 times of the total monthly imports. And when we move on to the fiscal side of things, we can see government still continuing its infrastructure drive. And with that, we are expecting another double-digit budget deficit. So in 2020, we have recorded a budget deficit of 11.1%. So with the reduced government revenue and increased state expenditure, we expect another budget deficit of 10.1% and thereby to gradually reduce from 2022 onwards. So when we move on to the private sector credit, we can see in July, we have recorded private sector credit of 77 billion with the low interest rates environment, although there were some disruptions from the pandemic, and also state credit has recorded an increase of 327 billion. So with that, year-to-date state credit amounting to 6.6 trillion. So increase in private sector credit has resulted in dried up liquidity in the system. So this situation was further aggravated when the central bank increases the statutory reserve requirement from 2% to 4%. So with that, about 150 billion rupees has got wiped out from the system. So with that, we have recorded more than 5-year low liquidity value amounting to 105 billion in September. However, what we can see is with the term reverse repo conducted by CBSL, this negativity of liquidity is gradually reducing. However, on the other hand, CBSL is still continuing its quantitative easing technique. So with that, in August, CBSL Holdings has recorded 1.2 trillion, but by yesterday, that amount has even increased up to 1.4 trillion. So CBSL raises its policy rates in August 2021 and also raised the statutory reserve requirement, as I mentioned before. So with that, the liquidity concern has aggravated. So moving on to the private sector credit expectation, up to July, we have recorded a private sector credit growth of 8%. And for the latter half of the year, we expect 4% credit growth, considering the impact coming from the potential upward movement in interest rates and also disruption coming from the fourth wave. So therefore, for 2021 and 2022, we maintain private sector credit growth expectation of 12%. So when it comes to inflation, we expect inflation to be mainly driven from cost push inflation. So with that, we have increased our targeted band of inflation range from 4 to 6 up to 5% to 7%, considering that cost push inflation may impact the prices. So since the inflation is mostly coming from the cost push inflation and it was led by the currency devaluation, using the monetary tools to adjust the inflation might not work since it's not demand driven. However, what we expect is it may support to stabilize the currency in the future. So now we are coming to primary concern. So that is the debt. And that is also the talk of the town at the moment. So our total bond obligation loans amount to rupee 1 trillion in 2021 and 2022. Out of that, rupee bonds comprises the major component, while the rest is comprised from SLDBs and sovereign bonds. So to talk about this in more details, I would like to hand over the proceeding to Demantha. Demantha, it's over to you.
Thank you, Hiruni. So if you look at the bond obligations loan for 2021, we have just under ₹1 trillion of bond repayments, and it's slightly above ₹1 trillion if you look at 2022. So here we have taken all types of bonds into account, the ISBs, which is international sovereign bonds, and the SLDBs, which is Sri Lanka development bonds, and the rupee bonds all together converted into rupees. So let's first look at what the foreign currency debt requirement is. If you look at up to July next year, we have about $7 billion of repayment from August. So interesting thing to note is that September and October is having $1.4 billion of repayment. So there is no bond repayments in terms of SLDBs or sovereign bonds here. So it's mostly project loans here. And then if you look at November to July, we have about $5.3 billion of debt to be repaid. So this is with the interest component as well. So the problem we have is our reserves are, foreign currency reserves are around $3.5 billion. So we do have some expectations on future borrowings, but from the roadmap that was mentioned. But the main thing to note here is this is the first time that we are seeing in the recent past that the debt repayment is sort of, or the foreign currency reserves is sort of half of the debt repayment amount. Then if you, in terms of overall debt repayments, where does the pressure lie? So if you look at this graph, you can see that the first quarter and third quarter is where the pressure mainly lies. First quarter, we have just under $1 billion of SLDBs to repay, and we have a $500 million sovereign bond to repay. Then on the third quarter, it's mostly a $1 billion sovereign that we have to repay. However, when you go into the fourth quarter, that is of course mostly rupee bonds that is there to repay. Now, on the rupee bond market, also we seem to have a bit of a problem where there is basically lesser subscribers for the bond market, for the bond auction. So here you can see clearly that the treasury bill stock as a percentage has now risen to around 25% of the overall government securities market, clearly showing signs that investors are shifting more towards the short tenor, expecting more and more pressure on the mid to longer tenors. And treasury bill stock also has exceeded 2 trillion rupees for the first time. So let's summarize all of these factors together. Positives, you have the GDP, tourism, lower lending rates, and inflation that are at the positives, but a number of negatives: the higher budget deficit, rising credit growth, the negative liquidity levels, CBSL holdings, the rupee depreciation, and then the debt maturities, not only dollar, rupee debt is also pretty high. And then finally, the difficulty in raising foreign currency long-term debt. So here we are assigning the economic outlook as high risk. Now let's look at the external outlook. There also we are downgrading to high risk. In terms of ratings, we have the S&P and Moody's downgrading the outlook from, or the S&P has downgraded to negative and Moody's has made it under review. So Fitch doesn't provide an outlook for CCC and below countries. So here there are indications that there could be potential downgrades if the macroeconomic conditions further deteriorate. So here you can see that our ISB pricing has significantly increased, especially in the short term. But here what we want to bring your attention to is the mid to long tenors, where mostly the rates are at around the 15 to 16% mark, which makes it significantly difficult for us to go into the sovereign bond market internationally and raise funds. Global fund flow, if you look at it, there seems to be a tendency of increasing interest rates beyond June of this year. So strong indications that most countries are adopting rate hikes. So with this situation, we feel that there is a tendency for fund flow to be towards the more developed countries, where US is also looking at a tapering option. So this is how all three indicators have performed. We've downgraded all three segments. However, how do we put all these things together and assess the situation? So we here we are putting in the priority criteria here. Still has gone into high risk levels, and even credit growth is at medium high. Then if you look at the secondary criteria, again, most of the indicators are at high risk level. Even the investor confidence is pretty low. So we've assessed it at medium high. So overall, at our January report, we expected that there is a potential that Sri Lanka may move towards IMF program, but however, now if you look at the economic indicators are slightly below our expectations as well. So in that sort of a scenario, we feel that there is a very high possibility that we may move into some sort of IMF support. So we provide a probability of around 85% that we may seek some sort of assistance or support from the IMF over the next 6 to 8 months. So let's straight away go into the recommendations. I will start off with the bond market. Yes, we are looking at a significant amount of pressure in the yield curve. 150 to 200 basis points was what we were expecting at the time of publishing this report early September, but from there on we've seen a significant rise in rates. Now, why is that happening? Because we were expecting some sort of IMF support, but on one side the indicators have deteriorated, and on the other side we've seen in the roadmap the governor straight away telling that in the near term we may not move into a program. So in such a situation, we feel that our fixed income health score may slightly further deteriorate, and that is the main reason why rates are moving up. So we are maintaining our policy rate outlook. 2 for this year was what we were looking at. 1 we've already been seen in August, and we are looking at another 1 more rate hike towards during the 4th quarter. And we are also looking at first half next year. We are looking at 2 rate hikes during the first half. Then I've updated this chart for ease for you to understand the current bond yields that are there. So you can see that the rates have currently moved beyond our revised expectations as well for the second half. But now important thing to note is that the central bank has removed the cap for the options. So in such a situation, we are seeing a significant rise in the 1 year, and with that, once the 1 year moves to around 7.5 to 7.7 levels, we feel that there will be some sort of stability in the mid to long tenors as well. So we are holding our June rates as it is. So 8% for 1 year, 10% for the 5 year, and 10.5% for the 10 year is what we are looking at the peak rates. So slightly can move up further from the current rates as well if you look at it. So strong bearishness in the bond market is what we are looking at. Even our more less bullish bearish scenario, we are only allocating around 10%. So let's look at the banking rates. Of course, banking rates have, as expected, started moving up, though it's slightly delayed from our expectations. We are expecting around 150 basis point rise. So 9% is what we are looking at by around June next year. Exchange rate. So here there is some controversy with the central bank holding on to the dollar at 197.203. So we've provided our recommendations based on the fact that the government or the central bank will go into a soft peg. So in the roadmap itself, the governor indicated that there is going to be the restrictions on imports are going to be relaxed, and even the vehicle restrictions are likely to get relaxed by around December is what he explained. So with that, we feel that there will be a soft peg for the dollar for the imports to freely move, and we feel that once the tourism earnings start coming in, that will be allowed. And last year also we expected by end of this year to for imports to be relaxed. So that is what has been announced as well. So finally, let's look at the equity market. So with the bullish trend and the SPI moving up around, we've recommended to reduce exposure a bit to around 65% by August 20th. Around there, the index was around 8,400, but now has continued to move up. Market earnings have been really good. However, possible tax increase is our worry. So double-digit budget deficits are not sustainable in the long term. So we feel that whether we get IMF support or not, we feel that there is a high likelihood that government could go into tax increases. So it could be a retail tax or corporate tax increase, so or both together. So with that, what are we looking at? We have significantly downgraded our expectations, earnings expectations for next year into single digits. If you look at the current valuations, the chart is, this is at the time we published, the index is slightly higher than this, now at around the 9,600 mark. When we drew this chart, it was around the 9,300 mark, so slightly more expensive than what you see now. Here also a similar stance, so we are continuing to recommend to further start reducing exposure as the index move up. So around 9,300 was the level when we put out this expectation. So we were recommending to reduce exposure to 50% and cash allocation of 50%. So this is not a asset allocation per se that we are giving. Out of your equity allocated funds, we are recommending to reduce exposure to 50% from the bottom. The market has moved up 100%. So when at that moment of time, during at different levels, you should start reducing exposure. So what we are expecting investors to do is probably every 200 points, try and reduce your exposure, because the risk level in the economy is also rising and the market is also getting expensive. However, you do have a second option, which is aggressively shifting into defensive stocks. So if you do that, but from the dividends that you get, you could basically average down your stocks as well. So let's look at what are the major factors that could prevent our expectations. So China emerging as a savior, providing a big loan. So it can not only be China, it can be other countries as well, in a combined sense, coming in and providing a large loan. So the G2G funding is what we are looking at here. So, but 1 year of that is not going to be enough, because we have continuous debt repayment. So we need that sort of funding to continue over the next couple of 2 to 3 years as well. So similarly, FDI is also so $4 to $5 billion on a continuous basis is something that we require in order to build our reserves and go to better levels of foreign reserves. So in addition to that, on the negative side of it, something you need to consider is what if we go into some sort of sovereign default or a major debt restructuring, then also to the negative side, it could have a detrimental impact for our expectations. So again, I would like to remind you, yes, there are multiple factors that are likely to affect the investments. However, the primary of them all is the fiscal weakness, and that is likely to threaten the recovery process, and there is a likelihood that we may seek some sort of assistance from the IMF going forward. And something important before closing, I would like to mention that as you can see, there is a lot of uncertainties that are there in the market. That's what we wanted to point it out to all the investors. And so it could be locally, there is a lot of things happening. Even globally, Also, as I mentioned, a lot of things happening. So some things I didn't mention was the possible global financial crisis from the Evergrande scenario. So that is another thing that you need to consider. So all these uncertainties are there in the market, and I hope that our recommendations provided some sort of guidance to the investors to adjust your investments according to the uncertainty that is there in the market. And with that, I would like to remind you the quote of Peter Bernstein: the greatest strategies occur when people forget about uncertainties. So don't be ignorant of the uncertainties that are there around you, and we expect you to act accordingly, facing those uncertainties, keeping those in mind. Thank you very much. I end my presentation with that and hand over to Saima.
Thank you. And Hirani for that informative presentation. Now let us move on to one of the key presentations on today's agenda. Presentation on the renewable energy sector, which will be conducted by Vidishika Pereira and Hirani Pereira. Vidishika, over to you.
Thank you, Saima. Let me share the presentation. A small investment in green energy is about making a giant investment in our future. Hold that thought while I move on to the rest of the presentation. So as we all know, with the climate change concerns rising, the global economy has been making effort to move away from the greenhouse gas emitting fossil fuels towards more greener renewable energy sources. So this presentation aims to provide investors with a broad overview of the entire industry, which will help in turn them to make better investment decisions regarding the renewable energy stocks. So with that, let me begin our story under the theme of green energy powering the transition. So the presentation consists of 6 sections, of which the first 2 sections will cover the development of the power generation industry in Sri Lanka. And the third section will give a snapshot of the local industry players. And section 4 will brief on the prospects of the overseas market, which the players are currently operating in. And section 5 will touch on the risk aspect of the overall sector. And the final section will carry a brief note on the key outperforming stocks in the sector. So let's straight away move into the first section. The power generation or the power sector is being considered as a defensive sector. The power generation in Sri Lanka has been heading upward over the years with a 15-year CAGR of 6%, and is expected to grow even at a faster pace in the coming years, of course, with the support of the economic and technological developments. And here you can see the statistics over the last decade. The number of power stations has been grown by 178 to 306 in 2020. And the total installed capacity has also grown by 1,447 megawatts to 4,265 megawatts at the end of 2020. And also per capita electricity consumption has increased by 203 kilowatt hours per person to reach 652 kilowatt hours per person. So this growth is mainly stemming from the improvements in commercial and industrial sectors. As you can see the chart on the left-hand side, this is the chart on electricity consumption by tariff category. So in that, you can see the commercial and industrial sectors has been displaying a notable expansion over the domestic and religious category. And also in line with that, the number of consumer accounts under the commercial category has also been on a rising trend, outstripping the growth in other categories. Moving on, Here you can see there's a strong positive correlation between the GDP growth and the growth in electricity sales. So a key factor that will determine the power sector growth would be the growth in the economy. Accordingly, First Capital Research is expecting GDP growth of 4% in 2021 and 4.3% in 2022. Another factor that we need to consider is the population growth, which will support to amplify the electricity usage. So Sri Lanka is expecting a population growth of 0.3% over the next 5 years. So this will enable to increase the per capita electricity consumption, and thereby it will increase the demand for power generation. So moving on to the global front, as I have mentioned earlier, the environmental protection and the reducing CO2 emissions have become a global campaign. So, and in that, energy-related operations have been identified as the main culprit for this escalating CO2 emissions. So, because of that, there are several initiatives taken at the global scale to discourage this fossil fuel usage. So one such initiative is the Paris Agreement, also referred to as the Paris Climate Accords, which is an international treaty signed by 200 countries in 2015. And another such initiative is the carbon tax, a tax which is payable on the carbon content of the fossil fuel usage. And also, United Nations has embedded the need for clean energy as one of their goals under Sustainable Development Objectives. And they are working towards achieving 100% clean energy by 2050. So as a consequence of this mounting pressure towards the environmental protection, most countries have set up various policies to step into renewable energy. So here you can see some of the renewable energy targets declared by various countries. And as a result of those, the renewable energy share of total global electricity capacity is on a rising trend. So in line with the global trend, Sri Lanka has also laid plans to achieve 70% renewable energy by 2030, mainly targeting on non-conventional renewable energy sources, such as solar and wind. So currently, the renewable share accounts for about 36% of the overall energy mix. And to achieve a target of 70%, Sri Lanka is planning on various projects, including the first ever large-scale wind farm project undertaken by Ceylon Electricity Board, which is located in Mannar. And this has a total capacity of 100 megawatts. And this project is currently in the completion stage. And CEB is also planning on massive capacity expansions in wind and solar. And the current capacity is expected to multiply by more than 10 times with the support of the private sector participation. And also CEB, as the sole purchaser and distributor of electricity in Sri Lanka, has got into many power purchase agreements, mainly non-conventional renewable energy projects, covering a total of 539 megawatts. So you can see even the capacity additions during the past years in non-conventional renewable energy has also been on a rising trend. So from now on, I would like to hand over the presentation to Kiruni, and she will give you a brief on the local industry players and the prospects of overseas markets. And also she will touch on the risk aspect of the overall industry. Kiruni, over to you.
Thank you, Vidishika. Let me share the screen first. Yeah, so hope the screen is visible. Now I will talk about the local industry snapshot. So there are 6 players listed in the power and energy sector. So I will not go to detail about these 6 players, but the point that we want to highlight here is all these players are currently involved in the renewable energy operation, considering the substantial future potential. So when we move on to the operational statistics, so in terms of the installed capacity, we can see that LBL Energy dominating with a total capacity of 254 megawatts, and the second is the WindForce with 280. In terms of the portfolio diversification, we can see these 6 players have diversified into different energy sources like hydro, wind, thermal, solar, and biomass. In terms of their geographical location, we can see most of them have their installed capacity in Sri Lanka. In addition to that, they have diversified into countries like Bangladesh, Pakistan, Uganda, Nepal, and etc. So we have evaluated the attractiveness of the industry using the Porter's 5 forces model. So what we found there was, although there's a higher bargaining power with the Ceylon Electricity Board, the industry looks very attractive in terms of the threat of new entrants and threat of substitution, since the industry is of high capital intensive nature. The new entrants it's difficult for the new entrants to emerge into the industry, and also there are low substitutes. So in terms of the Porter's 5 forces model, industry looks attractive in terms of the multiple aspects. Now let's look at how the power generation in offshore markets happen. So as I mentioned before, a lot of players have moved into other countries in terms of their operations. So here you can see how's their geographical segregation of income. So you can see Vidulanka has 59% of income generating from Sri Lanka and 41% from Uganda. And in addition to that, WindForce has 70% of incomes from Sri Lanka, 6% from Uganda, 21% from Pakistan, and 3% from Ukraine. So we also have seen that a lot of players have positioned themselves in Bangladesh and Uganda, mainly due to the fact that they adopt a similar flow in the power sector that is similar to Sri Lanka. And also moving on to other prospective markets, we have identified that Asia is one of the emerging region in the world in terms of the growth and also in terms of the electricity generation. So Asia has a target of reaching 23% from the renewable energy by 2025. And in terms of the other countries, we have identified Africa, because Africa has a lot of unutilized renewable energy sources. So as you can see in this chart, so in 2018, the power generation from renewable energy sources is not that significant. But by 2040, this component is going to expand and dilate by 2040. So let's look at what sort of prospects we have in Bangladesh and Uganda. So Bangladesh is one of the emerging country in the Asian region, and the existing power capacity of 21,000 megawatts is going to expand up to 30,000 megawatts by 2030. And also they aim to reach 40% electrification by 2041. And at the moment, government is trying to seek the participation of the private sector in meeting their energy goals. So let's move on to Uganda. So currently power generation capacity is expected to widen up to 42,000 megawatts by 2040. And also they have a target to reach 80% electrification by 2040. So their generation mix will be more reshaped with the renewable energy sources along with the other nuclear sources. So here, the countries in blue are the countries that we already operate, and the countries in yellow are the countries that, that are currently under evaluation. So those countries are Zimbabwe, Myanmar, Laos, and Mongolia. So at the moment, the feasibilities are conducting in these countries with regard to the potential markets. And as I mentioned before, so a lot of players are operating in foreign countries, so they generate a sizable dollar income. So at the moment, we are witnessing a significant depreciation of rupee with regard to the US dollar. So by end of December 2021, we expect rupee to hover in the range of 218 to 224. And also by June 2022, we expect rupee to hover in the range of 225 to 240. So when there's a significant currency depreciation, companies who have a sizable foreign income is expected to significantly benefit. Now let's look at what are the embedded risks in the power and energy sector. So the main risk that we have identified is a high dependence on a single buyer, that is Ceylon Electricity Board. So Ceylon Electricity Board with its subsidiary Lankan Electricity Company Limited has a monopoly status in the industry. So although there's a competitive bidding process, CEB have a high bargaining power with regard to the power transmission. So when there's any sort of power failure with regard to CEB's power generation or any equipment failure may significantly impact the players operating in the industry. So we have identified the impact as high and also the likelihood as a medium. So the second risk is the currency risk and the interest rate risk. So as I mentioned before, since the players, players operating in the power and energy sector has sizable foreign revenue. So when there's a significant fluctuations in the foreign exchange rate, similar to what we witness now, it may significantly impact on their revenue. And also, we know these power projects are mainly dependent on the debt financing, and when there's a significant fluctuations in the interest rate, it might affect on their finance costs as well. So when it comes to the currency risk and the interest rate risk, there's a very high impact, and the likelihood also we can see as high. And third one is the changes in the policies and regulations. We can see there's a frequent changes in policies and regulations in Sri Lanka, not only with regard to the power generation, but also with regard to the other aspects as well. So since these power projects are of long-term nature, frequent changes in the policies and regulations can affect the decision-making ability. So we have taken the impact as high and also the likelihood as medium. Now to talk about the key outperformers, I'd like to hand over the proceeding to Vidushika. Vidushika, it's over to you.
I'll share my presentation again. So coming back to the most interesting segment of the presentation, to identify the key growth stocks among the listed players. So accordingly, we believe that the players who are having a significant portion of foreign income and also with a sizable amount of pipeline projects will play a vital role in determining the growth stocks. So in that capacity, only 3 companies are currently engaged in overseas operations, namely Lankan, LVL Energy and WindForce. But we also believe that the future profitability is dependent on the overall generation capacity of each of these players, in order to extract the benefits of the upcoming demand and also to enjoy the benefits of the expected rupee depreciation. So in that, based on these key criteria, LVL Energy and WindForce are taking the lead. And they run with a sizable portion of foreign income, and also they have the highest installed capacity, and also they have the highest capacity of pipeline projects when compared to the rest of the players. So out of all the players listed in the main board of Colombo Stock Exchange, we pick LVL Energy and WindForce as the key outperformers in the sector, mainly based on their strong growth characteristics on top of the positive outlook of the industry. So let's move on to more detail on these 2 companies. Starting off with LVL Energy, they currently have pipeline projects in both overseas as well as in Sri Lanka. And these projects are expected to commission by FY22 and will start boosting the revenue from there onwards. So among these projects, there's a hydro project in Nepal with a capacity of 10 megawatts. And also they have successfully ventured into solar projects by completing their first solar project with a capacity of 1 megawatt. And also there's another total of 5 megawatt projects in hand to complete in the coming year. Talking about LVL Energy's wind farms, they had to face an issue in supplying power for about more than a year due to a failure in CEB's Norelcholi grid substation. And it's been out of order since July 2020. And however, going forward, we expect this issue to iron out, and we expect LVL Energy to continue supply power during third quarter of FY22. And also one of the thermal power plants in Bangladesh was running at a low plant factor, mainly due to the excess supply that was there in Bangladesh during the pandemic era. However, with the revival in economic activities in Bangladesh, now there's a higher demand for power, and we expect there could be a significant improvement in the plant factors of these thermal plants. And finally, we expect the rupee depreciation will also be an added reward in boosting the profitability of LVL. So with all these facts, we are positive about the future growth of LVL Energy, mainly based on their potential to utilize their current and pipeline project capacities to grab those sector opportunities that we expect to come in future. So with that, we have estimated the share price of LVL Energy to reach LCAR 13 for FY22 and LCAR 19 for FY23 from the current market price of LCAR 1070. Next, I will move on to WindForce. WindForce also has a solid pipeline of projects in local as well as overseas. Sort of these, they are planning on a project in Senegal with a capacity of 30 megawatts. And in terms of the local projects, they have a wind project planned in Mana with a capacity of 15 megawatts. And also, there's a solar project in Batiklo with a capacity of 10 megawatts. And also, they are on to new waste to energy project with a capacity of 11.5 megawatts in Karadiana. This will also support for the waste management in Sri Lanka. And moving from that, WindForce also had to face that same issue with the Norwich-Choli grid substation being out of order. So as I mentioned earlier, we expect the situation to normalize and to start resume power intake from the wind projects towards the latter part of FY22. Another positive factor about wind is that their footprint to Africa region through their projects in Uganda and Senegal. This will untap a massive renewable energy potential as explained by Hiruni earlier. So this and together with that, their exposure to foreign income will also going to benefit out of the expected rupee depreciation. So considering all these facts, we are positive on the counter and we identify WindForce as the most rapidly growing renewable energy player in the industry. And with that, we have estimated the share price of WindForce to reach LCAR 21 for FY22 and LCAR 25 for FY23 from the current market price of LCAR 1870. So that brings us to the end of the presentation. And I would like to conclude by reminding you that a small investment in green energy is about making a giant investment in our future. Thank you so much.
Thank you, Vidushrika and Hiruni, for that insightful presentation. We have now come to the most awaited segment of the day, the panel discussion. This discussion will mainly touch on developments in the renewable energy sector and the economy as a whole. An eminent panel has joined us today who have gained utmost expertise in their respective fields. I would like to take this moment to introduce our esteemed four panelists. Professor Rohan Samarajiva and Deshal are the prominent economists who have joined us today to share their insights. Professor Rohan Samarajiva is the founding chair of LIRNEasia, a think tank active across South and Southeast Asia and was its first CEO. He is a member of the UN Global Pulse Advisory Group on Data and Artificial Intelligence. He was chair of the ICT agency, the apex body for information and communication technology within the government of Sri Lanka in 2018 and 19, having been one of its founding directors. He served as Director General of the Telecommunications Regulatory Commission of Sri Lanka. Professor Samarajiva was Associate Professor of Communication and Public Policy at The Ohio State University in the US and Visiting Professor of Economics of Infrastructure at the Delft University of Technology in the Netherlands. Professor Rohan Samarajiva frequently writes and speaks on policy matters at the intersection of economics, law, and technology. His publications include a book in Sinhala on economic strategies appropriate for us. Deshal, another key personnel in our panel, is an economist who has experience across government, private sector, and academia. He is a research director at Verité Research, a Colombo-based think tank. He previously served as an advisor to the Ministry of Finance, prior to which he worked in the corporate sector as senior economist at the Haley's Group. He was a commissioner at the Securities and Exchange Commission of Sri Lanka in 2018 and 19. He has served on a number of corporate and non-corporate boards. Currently, Deshal serves as an independent non-executive director on the board of Sampat Bank PLC, Janashakti Insurance PLC, Capital Alliance Investments Limited, and TNA Radio Network Private Limited. Deshal's publications can be found in a number of books and journals, and he was recognized by the World Economic Forum as a young global leader in 2019. Joining us, representing two major listed players in the renewable energy sector, are Rizmin Razik from WindForce and Chandrien from Lankan Ventures PLC. Rizmin Razik joined WindForce in 2018 and is the company's current Chief Financial Officer. He is a strategic business leader with 20 years of finance and general management experience across diverse corporates, ranging from large-scale multinationals, listed conglomerates, and startups. This includes 12 years of broad senior management and head of finance experience and 7 years of experience in Africa. Having commenced his career in John Keys Holdings PLC in late 2000, he later joined Lankan Marine Services Limited as head of commercial operations in 2005. Subsequently, he worked at Maersk Mauritania SA and later at Maersk Line Cameroon Cluster, both in the capacity of the Chief Financial Officer and Nerd Board member. Rizmin Razik holds a Bachelor of Physical Science from the University of Colombo, an MBA from the Postgraduate Institute of Management, Sri Jawadanapura, and is also a fellow member of the Chartered Institute of Management Accountants, UK. Rizmin has also followed executive education programs at Wharton Business School, University of Pennsylvania, and at INSEAD, France. Chandrien, another eminent personnel from the renewable energy sector, is a senior portfolio manager of Lankan Ventures PLC. He holds a Bachelor of Science degree in Engineering, Textile and Clothing Technology from the University of Moratuwa and is a past finalist of the Chartered Institute of Management Accountants, UK. He is currently reading for his Bachelor of Laws degree at the Open University of Sri Lanka. Chandrien started his professional career in finance at MAS Holdings in 2009 and held the position of accountant at MAS Bodyline at the time of leaving MAS Group to join LVL in 2011. Chandrien joined CIMB Investment Bank Sri Lanka in 2014 and rejoined LVL in 2018, having gained valuable sell-side exposure at the bank. Our moderator for the panel discussion, Dilshan Wirasekara, is the Director, Chief Executive Officer of First Capital Holdings PLC and is a Director of the Colombo Stock Exchange. He is an experienced professional with a career spanning over 25 years, comprising diversified expertise in financial services, including banking, treasury and investment management, capital market strategy, and corporate finance advisory services. Having joined First Capital in 2013, Dilshan steered the company, a full-service investment institution holding licenses as a primary dealer in government securities, stockbrokering as a full trading member of the CSC, unit trust management and wealth management, licensed by SEC and debt structuring, trading and corporate finance advisory, in addition to its fully fledged research unit covering macro fundamentals, equity and fixed income to establish itself as a significant contributor to the local capital market industry. He spearheaded the formation of key debt structuring deals with internationally based development financial institutions, as well as the signing of strategic partnerships with foreign institutions focusing on emerging markets such as Sri Lanka. Dilshan Wirasekara is the former General Manager of SoftLogic Capital PLC, guiding investment and trading portfolio management across subsidiaries, inclusive of the group's licensed finance company, composite insurer, and equity brokerage, prior to which he was Head of Treasury at Nations Trust Bank PLC. He specializes in asset and liability risk management, having secured the accolade of leading and representing 2 Sri Lankan companies in winning the International Bank Asset and Liability Competition, organized annually by the Netherlands Development Finance Company, German Investment Corporation, and Proparco, a subsidiary of the agent Frank Hayes de Development. Dilshan is an alumnus of INSEAD, having successfully completed his executive professional education at INSEAD Business School in Fontainebleau, France. He is also an alumnus of AOTS, Tokyo, Japan. With that, once again, I would like to remind our fellow audience to post your questions on the Q&A section of the Zoom app. And if you have joined via Facebook, then drop your questions in the comment section below. Now, I would like to hand over the rest of the proceedings to Dilshan Wirasekara to commence the panel discussion. Dilshan, over to you.
Thank you, Zaima, and very warm welcome to our audience who've been with us for some time now. Very warm welcome also to our panelists, Professor Samarajiva, Deshal, Rizmin, Chandrien. Thank you very much for joining us and taking time off your busy schedules for this session with us. The format of which what I would like to follow is to first move around with the macroeconomic policy related questions directed to Deshal and Professor Samarajiva, and thereafter maybe move towards the renewable energy related questions to both Rizmin and Chandrien. I think our audience also are posting questions on the various platforms which will be collated, relevant questions, and depending on time, we will try to accommodate the most amount of questions that we can. However, if there are questions that go unanswered, I can assure the audience that our research will get back to you with some of those answers. So let's get started with that. And I'd like to first direct the question to Deshal. Deshal, I think it's been in the news quite a lot, and I mean it's not a secret that Sri Lanka economic indicators are significantly weakening and that we are at a very vulnerable stage currently in terms of the macroeconomy. We've seen, obviously, the government make statements of wanting a homegrown solution as opposed to going to the IMF. However, we know we've gone to the IMF 16 different occasions previously in our history. So just like to get your perspective. I mean, is the IMF actually this big bad wolf that it's painted out to be? Do you think IMF is likely to put tough conditions on Sri Lanka if we do go to them? What are your thoughts, Deshal?
Thanks, Dilshan. And first of all, thank you to First Capital for the invitation to speak this afternoon. Yeah, great question to kick things off. I think it provides a lot of context to the overall challenges we face. Now, when it comes to the IMF, it's always a negotiation, right? So in terms of the conditions that are eventually agreed upon, if a country were to allow the IMF to drive the agenda in terms of setting that, then it's very possible that you can have fairly onerous conditions. On the other hand, if a country is proactive and takes the initiative in terms of developing its own fiscal adjustment strategy, and then takes that to the IMF as a kind of basis for negotiation, then the country has a much better chance of kind of driving the agenda in terms of what those conditions look like and how they are structured. And that is actually would like that the second approach that would actually likely to be more favored by the IMF as well. Because the IMF would also prefer a situation where there is a domestically driven program, which has got buy-in at a political level that is typically much more sustainable and much more inclusive as well. So the IMF would also prefer if a country brings a program to the IMF as a basis for negotiation and then agreeing upon those conditions along those lines. So really, as I said, it comes down to a negotiation as to whether the conditions are too onerous or manageable and in line with the country's economic priorities. Now, what would those conditions look like in Sri Lanka's case? I mean, typically, these conditions of what IMF in IMF jargon is called performance criteria. In Sri Lanka's case, it's likely to hinge around the fiscal adjustment. As we all know, Sri Lanka has had significant fiscal instability in recent times. We ran a budget deficit of 14% of GDP in 2020. So the fiscal adjustment is likely to be front and center of any IMF program, much like it was in the most recent IMF program that Sri Lanka had between 2016 and 2019. And within that fiscal adjustment, again, the focus is more likely to be on the revenue side. Sri Lanka's expenditure is largely non-discretionary expenditure. There's not a lot of space in terms of reducing expenditure in a way that can meaningfully reduce that deficit. So revenue-based fiscal consolidation is likely to again form the basis of a future IMF program for Sri Lanka as well. Now, again, the negotiation is going to be critical in terms of how that revenue adjustment, which of course will entail adjustments in terms of rates and base of taxation, and that can have that can have adverse impacts in terms of creating headwinds for economic growth. So the negotiation with the IMF is critical in terms of calibrating the depth and the sequencing of those fiscal adjustments as well. So again, that negotiation becomes pretty critical. And finally, I think the bigger question that we need to address is whether Sri Lanka requires the IMF or not. Right now, the problem that we are trying to solve as a country is how can Sri Lanka regain access to global capital markets to be able to roll over its maturing external liabilities and then to kind of overcome this significant debt challenge that we have, particularly in the coming years. Now, this requires us to re-rate our credit ratings to get above a CCC level, back up to the B level, so that we can regain access to global capital markets. And that in turn requires a credible fiscal adjustment plan and a monetary plan that is able to convince markets that Sri Lanka is on the right path in terms of the required macroeconomic reforms. The role of the IMF in this context is really to provide that external anchor of credibility to really help convince markets that this plan is that the country has a sound plan that will help the ratings to be adjusted and then we gain access to global capital markets.
Thank you, Deshal. I think that's quite clear. I'd like to move on to Professor Samarajiva. So your expertise is in the field of public sector reform. While I would come and touch upon the long-term reforms a little bit later, would like to get your perspective to what are the quick wins the government can sort of adopt given the current situation we are faced. I mean, it is a critical situation with the pandemic. What are sort of low-hanging fruits that we can maybe look at immediately to get a sort of a head start? Would like to hear your thoughts on that.
Thank you for that question. I think the issue around low-hanging fruit and quick wins is, if I can see them, why can't everybody else? And if they're so obvious, why aren't they being plucked? Why aren't the low-hanging fruit being plucked? So I'm afraid, I think we are facing an economic crisis of an unprecedented nature. In my view, I think the only parallel I can think of is what happened in this country in the 1930s, when our per capita GDP, according to historical records, went sort of to about half what it was. And then we got hit by malaria and all kinds of things happened, and a complete realignment of the political environment also occurred in around 1935. So I don't think there are easy fixes to the problems that we are in. I'd like to latch on to one question that Deshal brought up, which is the importance of credible actions. So how do we go for credibility in a situation that we are in? I agree completely that we have to have our own recovery plan. We have to have our own plan about how we get our revenues up and our expenditures under control and become more like a normal government, normal state structure. So in order to do that, I'm afraid that my recommendation is going to sound to many people like somewhat unrealistic. I think we need to bring back the independent Commission's components of the 19th Amendment. That is some form of bipartisan agreement on the appointments made to the key economic positions, such as the Monetary Board, the Public Utilities Commission, the Elections Commission. That's not purely economic, but why not? I think we really need to get some kind of bipartisan consensus behind the difficult actions that we have to take. There's no question that there is pain in every path that we are going to take. So pain is easier to manage, to explain to people, and to make it sustainable, because one of our problems with the 16 interactions with the IMF is that in many cases, we just didn't follow through. We dropped the programs halfway through. It's the credibility that's at issue. Whatever we have said, we have not been able to follow through with. So if we can get the opposition also into the equation, restore, if not the entirety of the 19th Amendment, that would be my preference, but at least the components regarding appointments. And I would go even now, I would say is doable. That's not very difficult. I think the more difficult thing is to go beyond that and to bring back, if necessary, even Sri Lankans who are living abroad, who have left the country but have achieved some levels of competency abroad, bring non-partisan people who are not part of the Colombo networks and bring them and put them into key positions. That's how you get credibility in a situation like this. Some of what I have to say will be on the expenditure side about having to do some divestitures of state ownership also. Even for that, I think we need credible people heading the regulatory authorities and credible people managing the privatization activity. Because otherwise, what we are going to have is this endless talk of people in the opposition saying, oh my God, that's corrupt, that's non-transparent, that's illegitimate, and so on. And the whole thing comes down. Just to give you one example to conclude with. Right at the beginning with the Port City Commission, the statement was made by no one, by P.V. Jayasundara, Dr. P.V. Jayasundara himself, that the key positions would be advertised internationally and that we would hire people of impeccable international credentials. In the political firefight that occurred over the Port City, now what have we got? We've got people who really cannot be held very credible, whose qualifications are more about loyalty, with one or two exceptions, I would say, and less about internationally viable credentials. So I think we need to try to avoid that. And for that, we need this kind of consensus on the actions that we are going to take to get us out of the hole that we are in.
Thank you, Professor, for that. Deshal, I'd like to move back to you and really looking at the debt dynamics. So I believe we have, if you look at our foreign currency debt profile, something like a $4 billion repayment over the next 3 to 4 years each year. And that is sort of the biggest challenge, I think, lying ahead of us now. Various people have been talking about different terms, you know, default, restructuring, moratorium, and we've seen the central bank in its roadmap sort of looking at raising new funds over the next 3 to 6 months. And if successful, obviously, then you have a plan for repayment. But I'd just like to get your perspective on, based on the current situation, we are sitting on $3.5 billion US, but you have 4 billion maturing every year. A large part of it next year, early next year, Jan, we have a 500 million. What approach do you think we should take, Deshal, in terms of the debt repayment? What strategy should we take? What would you really advise the government to do in this instance?
Yeah, so yeah, spot on in terms of the large outflows that we have. So we have $4 to $5 billion worth of sovereign liabilities each year. On top of that, you have to fund a current account deficit of around 2 billion per year as well. Right? So you're looking at a gross funding requirement in the range of 7 billion, which is well above our typical inflows in terms of FDI, bilateral, multilateral inflows into the forex system. And now for a CCC rated sovereign that doesn't have access to global capital markets, it becomes difficult even to raise those typical inflows, right? So even from a G2G perspective of FDI, when you're at CCC, it makes it a little bit more difficult to make those conversions. And as you said, reserves are at 3.5 billion as at end of August. It's likely to dip in September. There are a few payments in September as well, so there's likely to see a dip in September. And then the challenges in terms of how we meet our external liabilities with reserves being squeezed in the way that they have been. Now, the trade-off that we are seeing right now is that we are trying to restrict all the outflows, whether that's in terms of imports, whether it's in terms of the other other outpayments on the forex side. They're trying to restrict those outflows in order to repay the bondholders in full. So these bondholders have taken the risk in terms of investing in Sri Lanka. We are trying to repay them in full, and we are restricting our outflows in doing so. Now, the restrictions on our outflows does cause pain to the economy, right? From a basic consumption level, we've seen shortages in terms of key commodities, but more, I think quite significantly, we're also seeing difficulties in terms of the manufacturing sector, finding it challenging to obtain raw materials and other inputs into the production process on a timely and cost-effective way, right? So these are the costs that we are facing in the attempts to settle our creditors in full. And of course, at some point, those costs become probably too onerous to bear. And at that point, a restructuring becomes pretty much the only option that a government would have in terms of managing its overall effects situation, right? What the government is looking at present, which was also highlighted in the roadmap, is looking at a few alternative options. So one is the divestment of state-owned assets to raise some cash. The challenge that I see there is that typically divestment of assets in Sri Lanka is politically quite challenging. And in terms of the cash flow, the volumes of cash flow that we require, this would entail the divestment of fairly strategic assets. It's difficult to raise that kind of money by doing small divestments here and there. Right? It's really big ticket items, and those are typically quite challenging. Now, the big hope is that what we've had with the excellent vaccination drive in the last 2 months, that tourism inflows can kind of address this gap that we see on the forex side. Now, tourism will certainly help in terms of reducing that or reducing the liquidity difficulties that we have on the forex side, but I don't see it being able to fully solve the problem. Again, the volumes are the real challenge here, right? And I think in the presentation earlier by Dimanta also, it takes some time to come back to where we were at the best case scenario in terms of tourism earnings. And to put some context to that, in 2018, that was our best year in terms of tourism revenue. Even in that year, we had a current account deficit of 3.2% of GDP. Right? So I don't think that tourism can solve the problem that we have in terms of our external challenges. It will certainly help on the liquidity side, but it's probably not enough. So really the way out on a sustainable basis is to upgrade our credit ratings, regain access to global capital markets in order to be able to roll over our debt. But now time is the factor here, right? So if we had maybe 24 months, then we could have a chance to do this with some time on the runway. But given the fact that we are at this kind of very limited reserve position with these payment liabilities maturing in the very near term, our two options become effectively restructuring or an outright default. Now, an outright default is something that you want to avoid at all costs. Right? That's basically what happened with Lebanon. It is something that will take almost decades, or in some cases multiple decades, to come out of. But the restructuring is something that there is pain in the short term. It's not a fun party by any means, but it is probably the best option out of the scenarios that we have in front of us. And there again, that negotiation has to be done quite early. There's a role for the IMF in terms of being the arbiter between creditors and the sovereign. And I would see it really as a question of either restructuring or an outright default. And the outright default should be avoided at all costs.
Thank you, Deshal. Professor Samarajiva, moving back to you. So we talked about the reforms, but the government itself is sort of facing multiple challenges. On the one front, the government that came into power cut taxes, was hit by COVID. Import restrictions have prevented revenue collection at the border, which is a big part of government revenue, and obviously expenditure has also ballooned due to the pandemic and COVID-related expenses. Now, on top of that, we have a public sector and some SOEs. There are major loss-making SOEs. If you take CPC, CEB, Sri Lankan Airlines, to name a few, not only do they contribute in terms of losses, but probably the cost structure, bloated employee bases, or maybe inefficiencies that all of these sort of entities carry. In your opinion, what type of changes should we look at this juncture now to maybe turn around some of those SOEs and maybe have less of a burden of maintaining them or losses contributing to further budget deficits for the government. Your thoughts on that, sir?
Right. So I think we need particularly in times like this, we need a well-functioning, efficient government, state structures we need. So that will leave out. That's a more difficult problem, how to achieve that. Now let's focus on the state-owned business enterprises, as the central bank describes them, to, I think, emphasize the fact that they are businesses, first and foremost. Now, there are some, you take, for example, Litro, or you take CPC in the coming months, they'll be racking up even larger losses because the world gas prices and the world petroleum prices are going up as the world economy picks up and winter is coming in. Those prices are picking up and we are going to get hammered by that, and plus the effects of the exchange rate, difficulties in opening LCs, and all these related uncertainties are going to create problems for those companies. So I would say that we need, again, to go back to that word credible that has come up several times. If we are to show credible action on the expenditure side, I think there is a primary target that we have to go for, which is Sri Lankan Airlines, which has accumulated 316 billion rupees in losses up to now, and which is racking up even more debt as we go. Now, I was looking at, airline business is volatile anyway, and it's particularly susceptible to things like, bombings and the problem with the Easter bombing and then COVID and so on. So I was looking at Qatar, which is generally a very well-considered airline, or even Singapore Airlines. These are all making enormous losses. They're getting infusions from their governments to keep going. But the difference is that with Qatar, you had significant layoffs, thousands of people laid off, everybody getting a pay cut, and so on. And I don't think we saw that in the Sri Lankan case. So I think in order to get credibility, I think we should really move forward with privatizing Sri Lanka. And again, people might say, well, how likely is that? For 15 years, we've been dancing around this problem. But let's look at what's happening in India. Air India, which is, if anything, in worse position than Sri Lankan, with 14,000 billion Sri Lankan rupees. I converted the Indian numbers, which is 708 billion Indian rupee accumulated losses, is quite a ways. I won't say it's a done deal until it's done, but it's quite a ways with shortlisted parties identified and so on towards privatization. And when they talk about it, they talk about, this is a company with these enormous losses. The government has already moved some of the losses into a special purpose vehicle so that they can carry it, and it doesn't go along with the privatization. But they talk about things like Heathrow landing slots and so on, when they talk, and aircraft. Now, those kinds of things we also have. And our losses, by comparison, are not as bad. So I have a feeling that if the government is credible, they will try to get one of these things done. Now, their other action is the Selendiva operation, which, even though it's not formally stated as a Temasek clone, is more or less like a Temasek kind of thing, where you park all your assets and then you try to divest them or float them on the stock market and so on. But if that is the case, what I would say is, fine, let's look at the success factors of Temasek and the negative factors of other funds, like what we had in Malaysia with the IMDb scandal, and what we had with Bhutan's ill-fated attempt to clone Temasek in their country without a stock exchange. So really, let's look at these examples and try to get a viable, credible option of privatizing or partially divesting or getting the stock exchange and the private investors involved in some way, but using those learnings rather than this sort of surreptitious thing. Does anybody know who's running running a Selendiva? While everybody knows, even people who don't live in Singapore knows who the CEO of Temasek was, Ho Ching, who just went up to the trustees this month or so. So let's think about in those terms. Thanks.
Thank you, Professor. So let's move on to the renewable energy segment, and I'd like to direct a few questions to Rizmin and Chandrien on their subject matters. So Rizmin, first with you. I think Sri Lanka has sort of set a goal of achieving 70% renewable energy. However, renewable energy is somewhat cyclical in nature. Mother Nature plays a big part of achieving, those targets. Just would like to know, do you think, that target is achievable? Do you see any challenges, drawbacks of getting to that? Is it possible to really have such a large percentage of your energy come through renewable sources and yet not have disruptions to your energy supply? And in terms of storage, all that, do you feel the CEB really has the capacity to achieve this and sustain that going forward? Rizmin, would like to know your thoughts there.
Sorry. Thank you, Dilshan, for that interesting question, and thanks to First Capital for organizing this session and with the focus on the renewable energy. It's quite an important sector to focus at this point of time. And from the industry point of view, we welcome the move from the policymakers to this drive towards the 70% renewable energy. We believe it's a step in the right direction, which would have a multitude of socio-economic benefits, for the country, and also quite a good, impressive performance for the industry operators as well. If I look at it, a few things, obviously, all of us know, 70% renewable means it will have quite a positive impact on the carbon footprints and the green side of it. But also, having said that, on the other hand, in terms of the economic side, that will also have quite a significant impact on the country and also electricity board and industry players as well. If you look at it, at this point of time, average generation cost is about 23 rupees per kilowatt hour from the CEB side. But if you look at it, generation cost of or the PP price for the renewable energy is in the current context is almost half that price, which would drive the cost quite considerably down. Also, at the same time, one of the reasons why the average cost is high is also because of the use of emergency power and the more of thermal power plants, which would have an impact on indirectly also on the fuel bill. Because if you look at it, crude and the refined products which is imported to Sri Lanka, quite a heavy fuel bill on the furnace oil and everything, which would be, predominantly used in the power generation. So that would also taken out of the equation if we can come to the this 70% renewable energy target. That's kind of from the economic point of view. But having said that, as you rightly point out, there are enormous challenges in getting over there. If you look at it in the current context, we have a fairly large renewable energy source. I'm not saying about the non-conventional or the IPP, but if you look at the CEB, large hydros alone contributes quite a significant portion of the renewable, which come to about, if you look at it in the current context, close to about 50% on the renewable side in that context, if you take those sources into account. So getting into 70%, and then that is by the target of 2030, with the current installed capacity of 4.2 gigawatts to 6 gigawatt hours. So then, like basically, we need to have about renewables close to about 4 gigawatts to get to that start, which is quite achievable and also sustainable in my view. And CEB has also taken certain measures as of now, and also there are certain other measures which needs to be taken. Now, if you look at it, the current the plan or the immediate future, the focus more shifting focus towards LNG compared to the coal. As of now, we have ready available 300 megawatt plant, which is Yugadanavi plant. As of now, it runs on the heavy fuel, which is a multi-fuel plant, which when we have the LNG discharge terminal, it can start running on the LNG. And then also the second plant for another 300 megawatts, which is put up by Lankan transformers, will come to about another 300 megawatts. And the third one is floater. Basically, we are talking about 900 megawatts of LNG, which can obviously work as a base load plants, which would support and then enable CEB to use the renewables or the large reservoir-based plants as a spinning plants, which will help to balance this, as you rightly said, the cyclical effect, and intermittencies can be balanced by using that mechanism. Also, at the same time, that's what on the cards at the moment. But having said that, there are certain other measures, like if you take for us to balance this demand and the supply and to bring it to a somewhat of a equal position, introducing something like a smart grid, which should be on the cards as well, would enable CEB also to manage this more effectively. And then also, if you take the certain other measures, like obviously the battery storage are quite expensive. But instead of having the battery storage at the plant level, if we can have it at the grid level at the large scale, on the other hand, when we get the savings coming from having LNG plants running 900 megawatts and cutting down on the quite expensive emergency and the thermal, then CEB would have somewhat of funds to be allocated to the battery storage. That would also enable to have a right mix of the balances to achieve this 70% goal. So in my view, I think, it's a step in the right direction. It's a challenging, but it's doable. And I think in the good and the positive spirit, CEB has already taken certain measures, and there are certain other measures which needs to be taken. If you take that one, then it's going to be a realistic and a more sustainable objective.
Thank you, Rizmin, for that very comprehensive answer. I'd like to move to Chandrien, and maybe Chandrien also, you can give your views on the same question. So, in terms of moving towards 70% renewable energy by 2030, typically we'll have to sort of revolutionize our renewable energy sector. So, how do you see that panning out? But more specifically, I'd like you to also answer how you see, the industry competition developing, especially with regard to the bidding process. And are there any concerns in the industry about the competitive bidding process? And if so, what those are? So I'd like you to touch on that, Chandrien.
Yeah, as Rizmin pointed out, it's actually the step in the correct right direction. But the significant challenge would be, as he mentioned, to have this infrastructure in place. If you look at the grid, it will require a substantial upgrade to sustain such a generation mix. Plus, as he also alluded to, the storage capacity required will be also, which is very, very expensive right at the moment, is going to cost us. So, for example, a recent study done by CEB Engineers Union has estimated the cost of grid upgrades, including the installation of adequate storage, required to achieve this target to be around $3.7 billion US. So, which is roughly around the level of foreign exchange reserves we have right now. So I think that number helps us to put things into perspective and understand how feasible such target is. Although we might like to do it, but it will take, in my opinion, it will take a longer time. To be honest, on the bidding side, what we have recently seen is CEB introducing competitive bidding for renewable energy sector as well, which I think has delivered positive results overall. On one hand, what it has done is it has made the process transparent, and for a listed company like us, transparency is very important. We have benefited from the introduction of bidding. For example, our company managed to secure 6 solar power projects by participating in a competitive tender initiated by CEB in 2018. On the other hand, what this has done is that it has encouraged healthy competition among industry players, which has enabled CEB to lower its unit costs. So as a nation, I think we have benefited from tendering. However, like in any process, there are things that you need to improve, and if you do it diligently, I think we can probably avert a force to move out from competitive bidding. One such point to ponder is whether a competitive bidding process, as it applies to solar and wind, is suitable for mini hydro, let's say. So the answer to this question is, I think, no, given the location specific nature of hydropower projects, coupled with the sensitivity of such projects to local community living in the area, which makes it virtually impossible to apply a competitive bidding process. And another problematic aspect of competitive bidding process implemented by the CEB, at least initially, was the lack of protection for developers for unfavorable exchange rate movements, which can have a significant impact on the financial feasibility of a project. Particularly considering the total time it takes from the award to actual implementation, because you need to take a range of approvals, including going through a CEA environmental impact assessment process, which tend to affect the financial feasibility, particularly in a context like this, where there is an extreme level of pressure on the exchange rate. So it is important to avail the developer to such protection, which CEB has done in some of its subsequent tenders. So apart from that, I think there has to be some CEB also should think about a transparent points-based mechanism for tender evaluation, where they would also consider the track record of developers prior to awarding tender, rather than going for the lowest cost bidder purely. In previous tenders, what has transpired was that a party which submitted the lowest tariff and got awarded the project was essentially not capable of implementing it, and we have seen it happening throughout a few of CEB's tendering processes, and as a result, many of projects didn't see the light of day. But summing up, I think tendering process is certainly a step in the right direction, and I think there are certain issues that CEB might have to iron out, but overall it is going to give a positive outcome.
Thank you, Chandrien. Rizmin, just moving back to you quickly. We know WindForce has expanded overseas, multiple regions, Uganda, Pakistan, Ukraine. How would you compare those markets and the innovation, technological advancement that you see in those regions compared to Sri Lanka? Are there learnings for us? And how do we essentially stack up against peer or advanced nations in this renewable energy space, taking your experiences in those regions to account?
Yeah, Dilshan, I think, I mean, there are two sides. One is from the power plant or the power generation technology side. The other one is from the grid and the transmission lines side, of course. So if you take it in terms of technology, like, I mean, WindForce as an organization, we have basically acquired and accessed the most advanced technology in all the power plants that what we have been operating. I believe, like, it would be the same for most of other local entities as well. So if you take in terms of solar or wind, obviously hydro is quite there for some time. They have been using the most advanced technology and the machinery and the equipment, I mean, all over, like, whatever we use in Sri Lanka would be the same thing we would deploy in other plants. And then we are quite globally competitive. That has enabled us to maintain our plant uptime. I mean, with very competitive and at quite a high rates, and also to generate, I mean, with other factors, to have good plant factors as well, because we have the technology and the sophisticated equipment. But having said that, on the other hand, I mean, the learnings for us to take, I mean, as I mentioned earlier as well, that could be basically coming from the other side, that is from the transmission and the distribution side, where there's a lot of upgrades or the system development needs to be done. I mean, the basic or the most important thing at this point of time is, like, say, for example, introducing a smart grid and then also get into this distributed models and have a more decentralized structure, which would be supported with having a mechanism of a smart grid. So whatever the technological advances or the investment needs to be done is from the other hand, that is from the transmission and the distribution side.
Thank you, Rizmin. Chandrien, a quick question to you from our audience. There's a question. With global energy commodities rising rapidly across the board, what are the implications to your Bangladeshi operations? This question asked by the audience.
Yeah, if you look at the operation of a thermal power plant, if you look at its profitability, the lion's share of its profitability is driven by what we called the capacity charge. That is a payment, a fixed payment that is paid irrespective of the amount of generation that a plant is doing for a particular period. So, and in terms of fuel costs and everything, for each energy generated or energy unit generated, it is essentially a pass-through cost in terms of tariff that we are going to get paid. So in terms of commodity prices, so that gets reflected as a pass-through cost in our revenue. So I would say the impact is marginal in terms of rising oil prices. The impact is marginal on our profitability.
Okay, thank you, Chandrien. Deshal, would like to move back to you and again come focus on the macroeconomic side of things. I know some of these tough questions are directed at you, but you're probably the best to answer them. So we know, obviously, our reserve position is sort of pretty low, down to 2 months, 2.5 months of imports. But the government's central bank's taken a stance on sort of pegging the rupee at the 197.203. Now we've seen the trend that we saw the rate actually go up to 225, 230. Central bank intervene, issue circulars to banks, bring it back down. However, we know that there is issues with the supply side of it. So there's a long waiting list. We hear in the papers, goods not cleared in the ports, importers waiting in line for their dollars. We also know that there is foreign investors who come through IIA accounts and maybe sold off their rupee investments, waiting for over 2 months now to get their dollars and convert it back. So obviously, it's a challenge. Now, with the reserve position, Is this a strategy that you think can be sustained? What are your thoughts? Is there a better way of doing it than having a sort of a control peg? Your thoughts on that, Deshal?
Yeah, so at the current official rate of 203, you can see already some fundamental depreciation pressure, right? So at these rates, the import demand is significantly higher than what you're seeing on inflows. So it's clear that the market is expecting the rate to depreciate further. Now, the problem with maintaining an official peg like this is, in order to be able to make that a credible peg, you need to have the reserve buffer to be able to actually defend it, right? So in that situation, if the currency is depreciating, you need to be able to sell your reserves, basically sell dollars and keep your rupee value at a certain level. But the market also knows that Sri Lanka's reserve levels don't allow that, right? So the market is basically factoring in this expectation of the rupee to depreciate. Now, with those expectations in place, what happens is it creates incentives that can make the depreciation self-fulfilling. So, for instance, if you're expecting the rupee to weaken, exporters and remittances are going to be less eager to convert, and importers are going to be more keen to front load their purchases as well to avoid paying a higher cost when the expected depreciation comes in. So automatically what happens is your inflows decline, your outflows start increasing, and then that further pressure then builds up for the depreciation to actually take place. And this is a cycle that we have seen several times in the past as well, right? We've seen it in 2015-16, we've seen it in 2011-12. So the market is expecting this to kind of unravel. The best kind of numerical illustration of this is what has happened with remittances. Remittances, we know last year was outperformed significantly, but in the last 3 months, they've been 35% down year on year. And that's simply because the market is shifting out of the formal channels into the informal channel where you can get a significantly higher rate. So the disincentive for conversions that is created by this official rate at 200, 203 is also problematic in terms of reserve build-up as well. So there's a clear requirement for the central bank to build up its reserves in order to kind of create buffers to address our liability maturities. But what we are doing is we are disincentivizing our inflows, which then kind of hurts our ability to raise reserves as well. So I think it's quite difficult to sustain this for the medium term, beyond the immediate short term, without the reserve buffers to make it a credible peg. So I would agree with the forecast that the month also had in terms of the expectation of the rupee to actually further depreciate from where it is today.
Thank you, Deshal. We are sort of running short of time. So I'd like to direct maybe the last question for Professor Samarajiva, and then recap with each of our panelists, maybe giving closing remarks. And then we can sort of wind up. So the last question that I would like to direct to Professor Samarajiva is on the import restrictions that we've seen. So we've seen now for over a year, the import restrictions being there. However, irrespective of that, we've seen also imports hitting sort of all-time highs in a couple of months during that period. So even though the restrictions are in place, the numbers don't reflect a significant reduction on the import cost side of it. So just would like to know what do you think are the economic impacts of having these self-imposed import restrictions, and is there something else that we could do to sort of better manage our trade deficit?
I think the governor has taken some of the import restrictions off the table, which I think is very progressive. But you must remember that, roughly 60% of our imports are intermediate goods, 20% are investment goods, and 20% are consumer goods. So all the fuss was regarding on the consumer side, which really there isn't much to cut there. I think that I wouldn't go into too much detail, but I think if you do what Deshal is suggesting and what your presentations were also indicating was likely to happen, which is a significant depreciation of the Sri Lanka rupee, then I think you're likely to see the imports going down because people will still simply not be able to afford a lot of these things. Put petroleum products and gas and so on formulas, formula-based pricing, properly designed formula-based pricing. Again, you should have people conserving, people crunching demand in some form. So these are going to have some other impacts on the lower deciles in the population and so on, which will have to be looked after. But I think these are things that need to be done rather than try these very Byzantine, complicated signaling things that they were trying to do. Because you see, one of the things with those kinds of actions is that it changes purchasing behavior. I couldn't quite understand what people were doing with, fresh grapes or something, that they were bringing them in and sort of stockpiling them in refrigerated warehouses, which is what some of the proponents were advocating. But I could sort of see people, buying more mobile phones even before they had to buy them because they expect the government to clamp down on imports. So I think the clearest thing is to do is just let the rupee depreciate and then deal with the consequences.
Thank you, Professor. So I'd like to move back to Rizmin. If there are any closing remarks, comments you would like to leave our audience with, would like to invite you to do that now.
Yeah, Dilshan, I mean, we all aware that like we are in quite a bad shape as of now, and maybe at the bottom. But having said that, also like on the positive side, I mean, if you look at it, one of the main hits what we got was due to the COVID, and as of now we have 55% population vaccinated with 70%. Double dose, and then within about a month or so, achieving 70% would control to a great extent the impact of COVID, and hopefully we might not be required to go for another lockdown. And if we manage in the same context, with obviously we might need to have some social distancing and certain restrictive measures, but not a lockdown as such, which would slow down the economy. So in that context, I mean, that would have multiple effects for all the industries. I mean, even for our industries, like in the power generation will go up, it will have the ripple effect in the whole economy. Coming back to the normalization. So we believe the next 1 year or so, though we are at the bottom now, would see some great prospects, and economy would be getting to somewhat of a on the right track in the next 12 months time.
Thank you, Rizmin. Chandrien, if I can invite you to give your closing remarks, comments, if any, please.
Yeah, I think much of the points were already discussed by Professor Rohan and Deshal. I think these tasks that we have to do, I think we need to implement them very fast. Otherwise, hard landing, not just a soft landing, is inevitable. So that is the biggest challenge, and I think as a society also there has to be broader dialogue. I don't know, I mean, apart from these kind of discussions, we don't see these economic impacts are being talked much in the society, and I think there is a need for more platforms like this to popularize these discussions and keep people aware of the decisions that needs to be taken in the future for us to survive as a nation. Yes.
Thank you, Chandrien. Thank you very much. Deshal, any final comments from you?
Yeah, so I mean, look, I think in terms of the steps that are required to stabilize the economy, I think the roadmap did have some initial positive sentiments with regard to issues such as tapering off deficit financing. That's an important macroeconomic monetary policy normalization. I think it would be essential to see a similar measures in terms of the fiscal side of things to be presented in the budget as well. And I think that's the critical first step to get ourselves moving in terms of the reform agenda for stabilization, both from a monetary side and from a fiscal perspective. And of course, the next step is to kind of to really start being proactive and to act as fast as possible in terms of whatever negotiations are required with creditors, whether it's the IMF. Because if you look at things like, say, a restructuring of debt, there are a number of ways to skin this cat, right? You can have a simple reprofiling where you simply delay capital payments by a certain period of time, get some breathing space. You don't need to have haircuts in that situation. You don't need to have coupon delays. Get the breathing space. Have your once you get a couple of years to get your fiscal and monetary house in order, inflows will then start coming in as well. And then without having haircuts, you can address your debt repayments, your debt repayments as well. So the restructuring can be done in multiple ways. But again, to do all of this, we need to move fast. It becomes more and more difficult the longer we delay this and take it to the edge of the precipice. So the recent weeks, we've seen some positive directions in terms of that macroeconomic policy normalization. So hopefully we'll move forward in terms of any future negotiations as well that we expect.
Thank you, Deshal. Professor Samarajiva, final thoughts, comments from you, please, sir.
Yeah, thank you. I think the most important thing is to focus on credibility. We've got the budget coming up. One of the unfortunate observations we made of this government in the last few months has been that you come up with some grand plans about banning fertilizer, banning this, banning that, and then you backtrack. That's not good for anybody. It's not good for the government. It's not good for the economy because nobody knows where you're standing. So I think the really important point is we have to think about our people and whether they take what the government is saying seriously, whether they act accordingly, about our business people and investors and how they make their plans and how they organize themselves, and about our external partners and debtors and creditors and various people like that. So I think for the government to be a little more circumspect about the announcements that it makes and to be able to follow through with those, to be a little more, put more preparation into what it's saying. And this can be demonstrated, I think, by the new finance minister in the budget speech that's coming in by being modest and careful and conservative, I would even say, in the statements and claims that are being made.
Thank you, Professor. So I think we've come to the end of our discussion. A big thank you to all the panelists, Professor Samarajiva, Deshal, Rizmin and Chandrien. Thank you so much for joining us and allocating your time for this. Big thank you to our audience who've been with us for almost 2 hours now. Thank you very much for joining in. And again, a big thank you to my team and First Capital Research for putting this together and having this event today. So a very good evening to all of you, and we hope to see you at our next event. A good evening to you all.